So as you look at these numbers that have just come in, Omair, that have just come in this moment, do they tend to reinforce your view, or are you basically projecting even more weakness in the second half as we go forward?
No, I don't think there necessarily will be more weakness. Quite frankly, this is really backward-looking data in a sense. When we get the core deflator data, we already have the inputs from the CPI and the PPI to kind of get to this number. So we generally have a pretty good idea of how this is going to print. What we really are thinking about now is sort of the back end of the year, and what are we looking for in terms of core inflation moving forward. And here, I think things will pick up marginally versus the sort of March to June weakness that we had. But I don't think it's going to be really enough to get the year-over-year rates accelerating towards where the Fed would like to see them by the end of this year.
Hey, Art, where do you stand on inflation? We had Costin over at Goldman Sachs that says, look, if inflation stays here, you could see 2,600 on the S&P, but if it picks up, we're going to 2,400.
Yeah, I'll tell you, we've been looking for inflation to pick up for years now, and clearly there's both secular and structural issues there. The Fed is clearly working towards normalizing their balance sheet, still with a view that at some point in time we'll get closer to the 2% target on PCE, and we're just not getting anywhere close. So I think it's going to make the next topic we talk about in terms of stagflation pretty interesting and comical all at the same time. It's very difficult in the global economy to where we are in the labor market and productivity to see a massive increase in inflation at least over the next 12 to 18 months.
So does that mean you have to get then more constructive on the market, ironically?
Well, oddly enough, what it's going to do is keep them on track for the kind of gradualism that we've gotten used to over the last 8 years. So when they talk about normalizing the balance sheet, coming out of the gates in September, if we're somewhere between 20 and 40 billion of assets that have matured, they'll probably reinvest half of those and then talk about how that affected markets and see what kind of effect they have, and then take a month off and do the same thing in December. So I think everything that they're going to do throughout the course of this normalization process of the balance sheet, getting it from over 4 trillion down to between 2 and 2.5 trillion, is going to take years, not months, and I think that's going to have a much less of an impact on the overall market.
Omair, on inflation in the United States, let's use Germany as a case study. There must be some bigger global forces at play here. Germany has a currency that pretty much everyone that would come on a program like this would agree has a currency that is ridiculously undervalued for that respective economy. It has an unemployment rate at or near to record lows. It has PMIs printing in the high 50s. GDP's okay, yet inflation's south of 2%. So if Germany's our case study, doesn't it tell us that there's something bigger happening here?
Yeah, I think that's been the case, and that's something that everyone's been trying to understand for years, is what is the impact of globalization as well as technology on inflation. Clearly, it's become much more of a structural issue, and I think to some degree you can make the argument that, at least in the U.S., for example, perhaps the Fed really can't engineer inflation the way that they were able to in prior decades. Quite frankly, look at the core PCE over the last 20 years. Outside of a 2004 to 2008 period, we haven't held above 2% on a sustained basis. So, if you've missed on the downside 16 of the last 20 years, what does that say about your ability to really engineer inflation?